And I want to introduce our next presenter, who's actually the founder of Right Line Trading, a 20-year trading veteran and professional financial analyst. He's an Ivy League trained professional, graduated with a degree in applied mathematics. He was elected to the prestigious Phi Beta Kappa Honor Society, a former full-time professor at Thomas Jefferson University in Philadelphia, Pennsylvania. Is actually contracted by the U.S. Navy to build a complex mathematical decompression algorithm for deep water divers. Here to present Credit Spreads on Steroids is my mentor and personal friend, Dr. Mark Sachs.
Hey, Rory, thank you for the really gracious introduction. And before I start, I just want to give a 30-second preamble about David Weiss. I get all of David Weiss's trades via text message, and I have never seen a man trade with such amazing precision and such incredible accuracy. That 90% win rate that he posted is 100% accurate. And he waits, he has patience, and when he hits a trade, I'm telling you, you can pile into it. He is an amazing trader. So what I'm going to be discussing today, now the reason I have the slides configured like this is I want to draw on them. It's going to help me explain to you how the system works. So I'm not just projecting the slide, I'm actually showing all the tools. What we're going to be looking at is a very unique strategy for trading credit spreads. Credit spreads are two options that we're going to sell, and we're going to receive money from the market for selling them. Now, the system I use is very formulaic. I repeat it over and over again. It's got very hard and fast rules. It's based on applied mathematics and the optimization of the formula we use, and it returns us a really nice profit. And in addition, it's a tremendous way to preserve your equity. I mean, first and foremost, when you trade, is you don't want to give the market any of your money. The second goal you have is to make money. So this is a terrific way of making sure that you're not going to lose money, because it's a capital preservation strategy, and at the same time get a really nice return. Now, I just want to start very quickly with this disclaimer and make it clear that all signals and trading opportunities that we provide are for educational demonstration purposes only. We are not licensed money managers here at Right Line. Everyone understands that trading involves risk and that you can lose a substantial amount of money. So be very careful when you trade and never risk more than you can afford to lose. Now, here's the Right Line Trading team, and it really is growing tremendously. And I was the founder. I no longer own the company, and since I have turned it over to Mark Miller, he has just really exploded the company on just amazingly powerful systems. And I'm just really proud to be to remain associated with the company in a different way, but still really proud of how the company is done. Now, Rory really went over all of this. I did graduate from an Ivy League institution. I went to the University of Pennsylvania, was a full-time professor. I've always considered myself to have the mindset of a scientist, a teacher, and an academician. I've been an international speaker in many countries. I've spoken domestically in many cities. I've mentored close to 30,000 traders. I mean, I've been trading since 1997. I opened up my first trading account with TD Waterhouse, which no longer exists. TD Waterhouse was purchased by TD Ameritrade. It became TD Ameritrade. And now it's being absorbed by Schwab, and the whole platform is sort of morphing. I hope they don't take away the Thinkorswim component. I doubt that. But way back in 1997, when I opened it, it was TD Waterhouse. And just as an aside, when they put you on hold, they play the same music today as they do in 1997. I'm always telling them to please change it. Now, you're looking for a way to generate consistent income in any market using credit spreads. And credit spreads are a terrific trade configuration utilizing options. And I'm going to go a little bit further and say that by nature, I call myself a naked trader. I only like to buy calls and puts. I hate buying debit spreads, where I buy the spread and pay for it. But I think this only other really advantageous multi-legged way of trading options is by selling them in certain specific instances to someone else. You get a nice juicy credit. I'm going to show you exactly how we do it. Now, it's really important not to jump between strategies. You want to focus on one. Now, what's key about this presentation is nothing that I'm going to present to you is black box. You know, I'm not going to show you two moving averages, and when they cross, you're going to buy, or they cross to the upside, cross to the downside. The metrics that you need are quite complex, but you will master it, because part of what I do is I'm going to teach you how to trade credit spreads. So we're going to focus on them. And if you want to swing trade, I think this is a tremendously powerful way of doing so. Now, the thing that you need, I mean, emotionally, when you trade options, because they're leveraged, and obviously you're in a position where you can make or lose a substantial amount of money. Now, I've started gaining a lot of stock positions in my portfolio. I own Lockheed Martin, I own Energy, I own Freeport McMoran, which makes copper, and I don't really, I'm not really very concerned about my stock positions. I know, and I'm way in the green on all of them, and from day to day, none of them really give me any anxiety. But when you trade options, you must have a lot of psychological confidence that they're going to succeed. And in order to do that, you have to have a key fundamental understanding of why the strategy is going to work. Now, you've got to, whoever tells you you can win 25 or 30% of your trades and still make a mint is absolutely wrong. You have to win 50% of your trades. In this portfolio and in this service, we are winning 85% of our trades. I'm going to show you our track record, and you must prevent blowups. And we're going to set a very strict stop so that if the trade slides away from us, the loss we take is going to be minimized. Everything is preset, our target and our stops. I'm going to hand these to you when the trade is executed. Now, I want to add one thing, and that is I take every trade I recommend. I take in my live account in Thinkorswim or TD Ameritrade or Schwab, whatever you want to call it now. So what's really different about this strategy and about this program is that if it's good enough to give to you to trade, I should certainly have enough confidence to take the trade myself in a real money account. Now, if anybody ever challenges me on that, I will be more than happy to snapshot the trades live. The only thing I'm going to redact off the trade, obviously, is my trading account number. But you're going to see that I've executed the trade in real time at the same price I've offered it to you. I've told you to execute it at. And if the trade is closed, I will have closed my trade at the exact same price I have you exit the trade. That kind of manner of trading I have not seen by anybody else. They all tell you they made millions of dollars, but they don't tell you they take every trade they recommend. Now, this is a very simple and forgiving strategy when you trade credit spreads. You just have to know the right stocks and the right metrics to look at. It's a great way to generate consistent income in a market that has a mild directional view. You can trade it on a stock or an ETF, and we've traded both. And it's a very forgiving strategy. And I'm going to show you how forgiving it is. So if the trade moves against us, we still have the potential to make a lot of money on the trade. Now, as an example, if you buy a call, say $3 at a strike price of 100, you at least have to be at $103 per share at options expiration to break even. When we take a position at 100, all it has to close at is $100.01, and we keep 100% of the money that the market has given us at the time we execute the trade. There's limited risk, and there's obviously limited reward. They go hand in hand. You can't have obviously unlimited reward and have a limited risk. Now, why learn credit spreads? Again, you can profit if the stock price increases, decreases, or doesn't move at all. You have a limited loss potential. You never have to worry about blowing up when the market makes a huge move against us. Position sizing is critical. You must risk the same amount of money on every position. And as an old professor of mine used to say, remember that for all time to come. I mean, he was an Indian professor, and when he really was emphasizing something, he would say, remember for all time to come. It doesn't matter what amount of money you risk, whether you're going to risk $300 per position, $500 per position, $1,000 or $5,000. It must be equal in size on every trade. And it's a real simple strategy. On paper, we're going to take two primary credit spreads, and it has two legs. Now, if you're told that a stock has two directions, bullish and bearish, it's actually wrong. A stock has 5 directions. A stock can move sideways in consolidation, where really it's got some intrinsic variability, obviously some harmonic, but basically it doesn't have price appreciation or depreciation to any significant degree. And over the course of the month, it's just not going to move much at all. It's going to trend sideways. Now, you're also going to have a stock that has that we consider to have a mildly bullish trajectory, or it has a mildly bearish trajectory. These are the kind of stocks that lend itself really well to credit spreads. Ones that don't move at all and just move sideways, or ones that have a mildly bullish or a mildly bearish direction, as we anticipate. Now, if it happens that they skyrocket in price, all the better. It certainly doesn't hurt us. If it happens to be that on a bearish position, the stock collapses in price, wonderful. We're going to be able to collect 95 to 100% of the credit that was assigned to us at the time that we took the position. But we would have been better off buying a call here and better off buying a put here. So this is where credit spreads really, really help us. So you can see I just noted that right here. If you think something is going to take a really steep rise to the upside, you're going to monetize that trade the best with a call. A real nice collapse to the downside, up with a put. And then if you have a very mild bullish and very mild bearish anticipation in price, or a stock that you don't believe is really going to move in either direction to any significant degree, that's wonderful for a credit spread because you're going to make really great money. Now, when do you want to use credit spreads? Now, this is really, really important. And I think you hear all the time, you never buy options. You only sell options. And all the smart traders, they're selling options. Well, that couldn't be further from the truth. The truth is there are specific instances when buying a call is the best way to trade, or buying a put. And there are other instances where selling a credit spread is the most advantageous way to trade. And the way I like to explain it is picture yourself at an auction, and you're auctioning off an item that has a certain amount of value. Now, you have the ability to be standing at the podium and hitting the gavel, going once, going twice, so you're selling it. Or you have the position of being in the audience and bidding, and then you're buying it. Now, when do you want to be a buyer? And let's apply it directly to options. You want to be a buyer of an option when the cost of the option is very cheap. And an option will normally be cheap when it has very little implied volatility. Now, when do you want to be a seller? When do you want to be standing at the podium trying to get someone else to take it off your hands? And that is when implied volatility, when it's factored into the cost of the option, really skyrockets the price, so that when you sell it, you're going to get a lot of money for that sale. So it really depends primarily on implied volatility. When they're cheap, we buy, and when they're expensive, we let somebody else have them and take them off our hands. So we want to be a buyer and sitting in the audience and paying a fee when the option is cheap. We want to be the auctioneer and collecting a fee when the options are expensive. Now, a lot of people refer to credit spreads as volatility spreads. Others refer to them as time spreads. I like to, if you're going to refer to them as to anything besides just plain credit spreads, volatility spreads works fine. Because remember, we want to sell extremely expensive options. So they're going to be, that price is going to be massively inflated by volatility. So we're going to sell this spread to someone else, and we're going to collect a nice juicy amount of money. Now now remember, when you sell a spread, time is on your side. So theta decay or time decay works for you, because what you want to do is buy the position back where it's essentially close to worthless. And what happens? What does time do to the price of an option? It decimates it, especially as we move towards options expiration. Though we heavily rely on volatility, which is inflated price, our anticipation is we're going to get this arrow heading into volatility, and then as the trade matures, boom, volatility is simply going to explode out of the position. Volatility is going to leak out, and the value of the option that somebody else holds has now gotten really cheap, and we are sitting really pretty on the trade. Now, if we let time decay do its work, it's really going to start eating away at the whatever price is left on the option so that we can buy it back for pennies or let it expire worthless. And I really already went over implied volatility is really the key. The cost is low when implied volatility is low. It's high when implied volatility is high. Now, I just want to blow this up a little bit. And this is one of the reasons why I did this. I hope it's not too blurred. But this is Abbott Labs, and it's just an example. Now, we're going to take a bearish position. And you can see, whoops. I want to wiggle this around. Hang on. Well, it's not drawing on here. It's not doing it. Let me try this here. Here we go. You can see that Abbott Labs is heading down. So it's definitely moving to the downside. And we can also see that every time that Abbott Labs has taken a retracement long, right here, to this area of resistance, it then collapses, collapses, collapses. So we're going to look for Abbott Labs again to collapse to the downside as it approaches this area of resistance. Now we're going to sit, Abbott Labs is at 98 bucks right at the time that we're taking this trade. Now we're going to sell the 98 call. That's a 50 delta call. And we're going to buy a 25 delta call. Now we're going to go over this a lot. So I just want you to know that this is what we're going to do every time. We're going to sell the 50 delta and we're going to buy the 25 delta. Now there are a lot of traders that trade deeply out of the money credit spreads. I'm going to show you why that is a portfolio decimating strategy. Now we're going to collect $2.07 on a $5 wide position. The leg is 98 to 103. That's $5. So we round this off to $2. Our maximum win on the trade is 2. Our maximum loss on the trade is 3. Because we already have collected $2, the most we can lose on the trade is $3. Now that's a 40, I call that a 40% vertical width. And that's what we're going to look for every time that we trade. Now we're going to take it a little bit further. Hang on a second here. Now, here we go. Now, we're selling the 98. So if the trade, and it's bearish, so if the trade closes at options expiration at 98 or lower, that $2, it's really $2.07, but I rounded it to 2, we get to keep. And it doesn't matter how far it falls. It only has to fall 1 cent. If it trades at 98 even, we make 100% of the credit we received on the trade. If which is the same as $97.97. So you see, the stock doesn't have to move much for us to get a 100% winner. This is why I say it's such a forgiving strategy. Now, what happens if it moves against us? Now, between 98, if it moves up from 98 to 100.07, remember we collected $2.07 on the spread. So we have a $2.07 cushion. So if it moves from 98 up to $100.07, we're going to collect some of our premium. The profit's going to be between 0 and the full $207 on each spread. The only issue is if the stock if the stock trades between 100.7 and 103, that's where we're going to take a partial loss. Because remember, we've got that $2.07 cushion. So even if the trade moves against us, we're only going to take a relatively small loss if it stays below 103. So you can see that the critical component of this trade is the amount of credit that we receive on the trade or the percentage of the vertical width of the trade. I'm going to show you that again. Now, if it trades above 103, we're going to take a full loser. We're going to lose the $293. Now, this is an options expiration. If it moves above 103, say 2 weeks before options expiration, we can close the trade, and because we still have time premium left, we will lose. We will only have a partial loser. These metrics are all set up to give you a profit or loss at options expiration. So the key on a credit spread is how much money you collect when you sell the spread. Now, if you collect 33% of the vertical width, you're risking 67%. Now, if you win 67% of your trades, you're going to break even. Every time you lose a trade, you're going to lose $2. And every time you win a trade, you make 1-1, lose 2, 1-1, lose 2, 1-1, lose 2. So at a 33% vertical width, at 67%, that's where you're at break even. If you can trade with 85%, like we're doing, you're going to make really, really nice money. And in addition, we will never accept a vertical width of 33%. We're looking for a vertical width between 40 and 45%. So the amount of trades that we have to make, if we get a 45% vertical width, we only have to have 55% of our trades winners. And if we trade with an 85% win rate, we're going to make a significant amount of money. So stock selection is critical here. So here's what I wanted to show you. Let me see where the slide is. I think it's right here. See, now you have a 41% vertical width. Now, like I said, you only need 60% of your trades as winners to trade at break even. I mean, you're going to lose a little money on commissions, but essentially you're not eating into your capital at all. You win for $2, you're going to lose for $1.50. $2, $1.50. Now you're making profit at a 60% win rate. So this vertical width of 41% is really critical. to determine what your win rate has to be. And if you're significantly above that win rate, you're going to walk away with a really nice profit over time. Now, this is a trade that we actually engaged in. Now, I didn't left out the ticker, but it's MUX, and it's McEwen Mining. We sold the $7 put, which was the 50 delta, and we bought the $6 put, which was the 25 delta. And what we got was a 45% width. At this rate, we only need to win 55% of our trades. Now, if the trade, if McEwen Mining closed anywhere from $7 and higher, we make 100%. And we have a huge yellow width here because it can trade down. It's only a $7 stock. It can trade down 45 cents. And we're still going to make some money. It has to trade lower than that 45%. And the most we could lose per trade is $55. And we're looking to make $45. Now, those kind of metrics are what really drive this strategy. And it's all really in finding the best stocks. And let me tell you, it's not easy, but I'm going to show you how I do it. And I have a great trade going out Sunday night. Now, I just took as an example the iShares communication services sector. Actually, this is the spider. And I wanted to draw in the moving average because this is a retracement to a 50-period moving average. Every time you got a retracement to the 50, you have great volatility here. You sell a bullish spread, it goes up. You're going to make, in all probability, close to 100%. Retraces back to the 50, it rockets up. Retraces back to the 50, it rockets up. Retraces back to the 50, retraces back to the 50. Here it breaks. So you're going to take a loser. And then all we're going to do is we're going to change our strategy. So we get about 6 or 7 winners in a row. It finally breaks the 50. And now we're looking for a pullback to the 50, and we're going to short it. Up, down it goes. Up, down it goes. Up, down it goes. Up, down it goes. And as long as it continues to do that, we are going to stay bearish. Our 50-period moving average is the critical line that we use to determine whether a stock is bullish or bearish. I know a lot of people in the market use the 200-day, but that's too long for us because we're only going to take a position that lasts a maximum of 6 weeks and can last a lot shorter. So the 50 period is perfect for our purposes, and we're going to trade off of that. Now, here is the formula, and it's really very, very simple. Now, if you look at this, this is not proprietary. And in fact, this whole configuration here, I get from a platform that I have, and if you want it, you can get it for free. I want to give you all the information that I can. It's a really lousy brokerage. It's called First Trade. And it's in New York City. It's, it's very reputable. And but I mean, customer service is 9 to 5. I don't actively trade anything in it, but I love this platform. It's a little more simplistic than Thinkorswim. You get it for free if you open the account for $100. Or $50, it can sit there forever, and you'll get access to this tool, and it's very helpful when you configure your trades. So we're going to take a trade that's 45 days to expiration. We're going to sell the at the money calls or puts. We sell puts if we're bullish, calls if we're bearish, and we're always going to sell the 50 delta right where the price is. And we're going to buy the 25 delta option position. Now we're going to collect at least 1/3 of the vertical width, but I will not accept 33%. We're going to look for 40% or more. On MUX, we got 45%, but I will take a 40% because we only have to win 60% of our trades. We already know that, and we're trading at an 85% win rate. So we're going to make a lot of money. Now, credit spreads that generate more than, we're looking, this is the scanner. Now, I can't give you the scanner because unfortunately, it's on First Trade. Now, I use it and rely on it heavily. But like I said, if you go to Google and put in firsttrade.com, you can open up a brokerage account in 24 to 48 hours. And like I said, let 50 bucks sit there and you'll have access to the tool. And what it does is it has a wonderful credit spread scanner, and it tells you the premium width. On UPS, it's 41%. On Estee Lauder, it's 43%. Bristol Myers, the vertical width is 40%. I'm not sure what FITB is. It might be Fitbit, but I'm not really sure. So it's going to tell you this is a bearish, bearish, bearish. So this is how I sort of hone down on the positions. We only want to trade very liquid positions. So if the option doesn't have a lot of open interest and it doesn't turn a lot of volume for that specific option's expiration date, we're not trading it. And the option and the credit spread has to align with our technical directional view. If we believe it's going to trade sideways, we're fine. If it's going to take a mildly bullish or mildly bearish, we're good to go. If we believe it's going to skyrocket, we're going to buy a call. That is not the purpose of the service. And if I believe it's going to take a really strong move to the upside, I'm going to sidestep it. We don't need those positions. And maybe I won't sidestep it, but I'm not looking for trades that necessarily need to do that. Now, here's just more trades. Now, Wayfair I don't have on here, but I'll show you another one. Now, here's XLV. This is healthcare. And you can see it's taken a bearish position, and you can see the plot of the chart. Oh, look at that. Bearish. And get it to work. And we're going to look for it to trade right up to resistance, right here. Without wiggling this slide. But I think you get the idea. You can see where resistance is. Let me try to rotate it. It's right here. And then we're going to sell it, and we're going to take a bearish stance. And our anticipation is that we're going to get another move to the downside off of this position. And it doesn't have to move down much. All it has to do is move down 1 cent. Doesn't have to make any kind of big move down. Now here's another example. Here's IBB. I think that is the iShares biotech. And biotech is starting to make a bit of a recovery. And I actually traded in a different portfolio calls on IBB. We made really nice money. But this was when IBB was really getting clocked to the downside. And you can see it gave a bearish strategy with a 40% vertical width. Now we're gonna have to wait till it trades back up to resistance, and then we're going in. Now, these are all the metrics that we look at least I look at, and I'm gonna teach you the value of all of them in the educational sessions you're all gonna attend. Obviously, direction. Is it bullish, mildly bullish? Is it gonna consolidate, mildly bearish, or strongly bearish? If it's bullish, we're gonna sell a put spread. If it's bearish, we're gonna sell a call spread. The expiration date's almost always gonna be 42 days out. The two arms of the trade, we're gonna sell one put and buy one put. You already know the formula. We're gonna sell the 50 delta and buy the 25 delta on a bullish credit spread. That premium is critical. It determines the premium width, which is critical. And the intrinsic volatility, or IV rank, is going to determine whether we're buying or selling, very juicy, expensive options that we want to dump on someone else. Now, here, I'm just reiterating the formula. We sell the 50 delta, caller's put. Okay, great, Mark, thank you. So we're gonna sell the 50 delta, buy the 25. And as my professor said, remember for all time to come. And if it's bullish, we sell puts. If it's bearish, we sell calls. Pretty simple. It's really the stock. And one of the ways that I look at these is I look at the best performing or the worst performing sector. Now, at the time that I created this slide, the best performing sector was energy. And the best performing subsector within energy was the oil services and the drillers. So then we're going to look at the best stocks within these subsectors. Now, tech has a lot of subsectors that really can escape you. The communication sector, XLC, has a lot of subsectors. And some of them are really take really big moves. I'll tell you right now that a major bullish subsector in tech are the payment gateway systems. And we're going to trade on, the trade's going to go out Sunday night. Is going to be a trade in that subsector. It's really got a novel, incredibly powerful approach to the way that you transact business over the internet. It's not PayPal, it's not Square, it's not the standard companies that offer us gateway solutions. It is a really novel position. It's already up, I think, about 50% in the last 2 months, but it's got a long way to go. And I'll just tell you one other thing about it. 20% of all the stock is sold short. And one of the reasons it is rocketing so hard is the shorts are getting crushed. Now, there's still 20% of the shares sold short. So we've got the short sellers in a lot of pain. And if this thing presses up 25, 30, 40 cents, it's not an expensive stock, we can see this thing still rocket. Now, when you look at short interest, you look at days to cover based on the average volume that's turned on this stock. It will take 10 days to the shorts to cover their position. That's unbelievably high. So it's got a lot of tailwind. We're going to take it long, and we're going to get a net credit that's over 40%. I still have to write the position up. Now, here, what I'm going to do every Sunday night is I'm going to send you a condensed version of the scanner. It's going to give you the premium width. It's going to give you the IV rank, and it's going to go by premium width. The bigger the premium width, the better. Now, the scanner is excellent. I already showed you how it projects a chart, but it's still, you still have to vet it. Because I know people will push scanners and tell you they're going to make you trillionaires, but a scanner is a tool based on a fixed algorithm. And without you vetting it a little bit, looking at the price, looking at the chart, you're very likely to get in the right direction, but you won't get in at the exact opportune time. And when is that? Right off of that pullback to the 50, or right off of an area of strong resistance short or strong support to the long side off the 50. The whole strategy is really very simple. It takes time to master, but it's worth it. Now, we just closed Vertiv Holdings. Vertiv Holdings is in the tech sector. I'm running a little bit of overtime, so I'm not going to go into a lot of detail about it. It was a $5 wide spread. We got 40% credit, which is a 40% vertical width. I just played it safe, and I told everyone to buy it back at 30 cents. So we kept $170 for every for every spread that we sold, and we did extremely well. Now, let me see here. I don't know why this isn't showing the lower chart here, but because that's our win rate. Right now, this is a relatively new service. So we've only closed 20 trades, but we have 17 winners and 3 losers with an 85% win rate. Now we're trading with a vertical width between 40 and 45%. So we only need to win between 60 and 55% of our trades. And we're winning 85% of our trades. So you can see that if you took with an equal amount of money, an equal amount of risk across all 20 trades, you would be way in the green. We still have 2 open positions, and we're going to have a 3rd open position Sunday night. It's going to come out new. Now, I put this slide in there because I really do believe it. And it is, it's the old saying, those that can do and those that can't do teach. And I'll tell you, there's 100 million educational programs out there to teach you how to do this. And if I wanted to, I could just make a 10-part video series, sell it to you, and wash my hands of it. And that'd be the end of it. But I don't want to do that. I not only want to teach you the system, and I've pretty much really given you the core of the system right now, I want to give you the trades that I take. So I actually do, and I also teach. I'm not passing off to you for $2,000 an educational program, and then you have to run it on your own. I'm going to hold your hand through this whole thing. And remember, my money's on the line too. So I take these trades very seriously. And I just want to say this. I don't want to extend the time. I want to say this very briefly. When you hand out trades via an alert service and your own money is not on the line, your emotional investment and the way you look at the trade is very different when your loot is at risk as well. So I watch these trades like I can't tell you, because I want to make money. Now, here's what you're going to get. Now, I wrote you get 2 optimized credit spreads every Sunday, but in this market, I've reduced it to 1. And I want to be upfront with you because this is a tough market to trade, and I want to stay with an 85% win rate. That's more important. Sometimes quality is more important than quantity. And I have a terrific trade that I'm going to write up right after this webinar is over. Now, I'm going to give you the entry price that I take, the stop that I take, the targets that I take. Now, we may make that target juicier and juicier if that credit spread really goes strongly in our direction, but we're all going to move it together. Now, you're going to get multiple intra-week updates. I mean, I send out so many intra-week updates. I mean, they're going to hit your inbox often. We're going to get bi-monthly live credit spread training. I'm going to teach you how to do this on your own until credit spreads are coming out of your ears. And remember, if you trade options, this is one of the 2 extremely lucrative way to trades. You buy calls or puts, or you sell credit spreads. That's in my humble opinion. You want to take an iron condor, you want to take a butterfly, good luck. I don't like 3-wing trades. You got to bid and ask on every single wing. It's too hard to get in, too hard to get out. And at the end of the day, you're going to make the most money being a naked trader, buying calls or puts and selling credit spread when the option itself is really incredibly expensive. Why shell out your money when you can sell it to someone else and let them shell out their money? Now, I want to show you, I mean, we're really, I know this is said often, but this is really the truth. I mean, this is our holiday special. You've been getting steep discounts. I wanted to chime in with my service as well. Now, this sort of gives you a recap of what you're going to get. Now, you get 1 month for $49. It's normally $99. I think if we go down here, you're going to get the regular. It's actually $119. But it's $49 for 1 month. Now, you have to use the coupon code SAVE70. I'm sorry, SAVE $70 at checkout, and it will drop from $119 to $49. You want to take the system for a year. It's normally $13.96. You put in coupon code SAVE 500. It will drop to $8.96. And the really nice thing about the system is that you will be rebilled at the discount price. So it's really advantageous to go for the deal. Now, what I'm going to do right now, I'm really at the end of my presentation, and I'm going to answer any questions that there are. So let me open the box. There's a bunch. Let me, and I'm going to get to them all. Just hang on 1 sec. And it's really good to listen to questions because oftentimes the questions are really good and they bring to light certain really important features that you want to know about the system. What is the average alert sent on a week? What is the average alerts? I don't want to mispronounce your name, but we're going to send out only 1 trade a week right now. It's going to go out on Sunday night, but it's going to go out every single week. So sometimes we're still going to send out 2. Because sometimes intra-week, I will find another trade that I just love. So you're going to get a minimum of 1 and a maximum of 2. But remember, they're consistently expiring over and over and over again. So at some point, you're going to have these spreads expiring at least 1 per week, week in, week out. You have the money flow tracker, James. That's going to help you a lot in determining price direction, for sure. It's a terrific system. Mark, if I remember, doesn't see the trade early. Do you recommend they adjust so that the net credit is closer to recommended. No, listen, Ray, Abbott was not a trade I took. All I did on Abbott was just use it as an example, just to give you a feel for the trade. MUX was a trade I took, and VER and Vertiv was a trade I just closed. If I had the time, I would show you all 20 trades that I took. And you're going to get those 20 trades in your first alert, because my entire track record is listed below. I keep every closed trade in the portfolio, so you can see what we traded. You can see the amount of profit we made on the trades. I mean, we've closed out some home run trades, I can tell you that. And we're going to continue to do so. And really, over the long haul, to really boil it down, it's a matter of math. If you can win 75 to 80% of your trades, and your vertical width is 40 to 45%, you're gonna cut a nice profit. And remember, if you're bullish or bearish, all that stock has to do is go up a penny, go down a penny, or stay exactly where it is, and you collect 100% of the credit that is assigned to you at the time you take the trade. I'm gonna tell you the credit limit when the trade goes out. That's what you're gonna set. You're never gonna take what the market wants to give you. You're gonna tell the market what you want. And we execute a huge percentage of the trades I send out. I don't think we've missed more than one, but we are gonna demand a certain credit. What was the name of the brokerage firm? It's called First Trade. Mervin, I hope I got your name right, Mervin. First Trade, FIRSTTRADE. They have a nice website. I mean, you know, it's located in Manhattan. Customer service is 9 to 5. I don't actively trade it. I put a couple of grand in there, not much, and it's been sitting there for like the past 6 years. I don't touch it. All I want to do is use that tool, and it's very, very helpful. So it'll cost you nothing. And you can close the account and take out the exact same amount of money that you got back. And you do get like 2.5 or 3% because it's in a money market account. So you actually accrue interest. Hey, Ray. No problem at all. No problem. Yeah, that's in New York City, Mervin. I mean, it's not great to use to trade, although you can, but you're not. I mean, I strongly recommend Thinkorswim. I love Schwab. The commissions are low. You can call the people 24 hours a day. When you go to the trade desk, which is the Thinkorswim desk, those people are brilliant. And oftentimes the advice that they give you, they can't give you trading advice, but you can kind of wheedle it out of them because they're very, very knowledgeable. They will help you place a trade. And, you know, in some instances, we're going to take OCO orders. And an OCO cannot be configured on a lot of platforms. And an OCO is one order cancels the other. So we can set a stop and a target at the same time. If the target hits, the stop is canceled. If the stop is hit, the target's canceled. So OCO orders are really easy. I configure them on my phone. Takes me all of 15 seconds for an OCO. That's why I love TD Ameritrade. And Sem, I'm having trouble with the coupon code. It doesn't apply the discount. Let me talk to Rory for a second. Maybe the coupon code I put in is wrong.
Mark.
Yeah, Rory.
Mark? Hey, the coupon code is actually Happy Holidays.
Okay.
One word, Happy Holidays.
Okay, so it's happy. I'm sorry. I'm going to type it in. Here's the coupon. Is that the same for both sides, Rory? The yearly and the monthly?
No, for the annual membership, it's Happy Holidays.
So happy. Would you mind typing it in for me, Rory? Can you do that for me?
Yeah,
For the
I
month?
did. I typed it. I put it in the chat.
Okay, great, great. Okay, that's the problem. I don't know why I have the wrong coupon code. I apologize for that. But you should have a coupon code for the monthly and a coupon code for the yearly. And if Rory said he typed them in, I'm sure he did, and they're there. So I really thank you for the time that you've given me. Really, my mandate here is to not only make money for you, it's to make money for myself. Remember, it's an educational service. We're not money managers, but we all know the name of the game, and the name of the game is to learn how to trade successfully, and that's our goal. So again, I appreciate your time. Have a wonderful Saturday. Sunday, if you come aboard, you're going to get a really extensive explanation of a new trade that we're going to take on a payment gateway oriented stock. Have a really wonderful weekend, everyone. And I really thank you for your time. Bye-bye all.